I'm Kara Murphy, and this is Money with Murphy. Let's talk about Santa Claus, or more specifically, what we call a Santa Claus rally. The stock market tends to follow various patterns throughout the year. And while not true with every turn of the calendar, September tends to have the worst equity returns, and October tends to witness more market bottoms than any other month. This year, that pattern persisted as the S&P 500 declined in September by nearly 5%, and again in October by over 2%. In fact, it was partly due to this pattern that we anticipated a fourth quarter rally this year. The good news is that those disappointing returns are often followed by a more positive experience, often referred to as the Santa Claus rally. So what exactly does this mean? If we collect data going back to 1950, you can see that stock portfolios have tended to climb just as waistlines are expanding. Examining the period beginning the Tuesday before Thanksgiving through January 2nd, the S&P 500 index has tended to be up more than 3 out of 4 times. While returns in any one of those years have ranged widely, the average return was a respectable 2.3%. This year, it appears that holiday festivities may have started a little early. The S&P 500 has enjoyed an impressive rally, climbing over 8% just in the month of November. In fact, since 1928, we've only seen such strong gains in November fewer than 10 times. So what brought Santa Claus to town early this year? It's helpful to remember that the recent rally came only after a nearly 9% decline over the prior 3 months. Then, just as the market was looking dire, a storybook ending began to unfold. Inflation slowed even as the economy continued to grow, and the Federal Reserve appeared to reach an end of its interest rate hikes. Those factors combined led investors to increasingly predict a soft economic landing. Some are now even predicting rate cuts as early as the first quarter of 2024. The good news is that just because the holiday cheer started early doesn't necessarily mean it'll end early. In fact, in years when the S&P 500 exhibited strong momentum throughout the entire year, on the order of 15% or so gains through November, like we've seen this year, the momentum has tended to continue. In fact, in those instances, the stock market has generated positive returns in December 2/3 of the time, with gains in that final month of the year averaging a robust 1.4%. So what exactly causes this so-called Santa Claus rally? Well, it's not particularly clear. Some speculate that the rally is fueled by end-of-year tax considerations or the anticipation of money managers going on vacation, or perhaps just excess eggnog. While these seasonal trends are interesting and they do tend to hold up well, they aren't significant enough to be relied upon as an investment strategy. The most time-tested method of building wealth over time remains a long-term focused and a diversified portfolio. Whatever holiday you're celebrating this season, I hope it's a good one. And until next time, invest wisely and live richly.